Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending January 28, 2022. So it's pretty windy in the markets. Even my hair is now undone. So we'll discuss what's happening, what's causing this volatility, and what to do with this volatility right now. All right, so a lot of red on the screen. The only thing that's not red is the price of oil, up 15% year to date. Other than that, well, bonds negative. So again, when rates are going higher, you have a loss in the short term on bonds. So if you want to hear more about that, we have the Economics and Finance 101 section on the ia.ca/economy webpage. So recommend that you go there. Minus 3% for the index, the universe index year to date, minus close to 6% for the long index. So negative for bonds. Equities, I mean, negative all over the place. The S&P 500 is still in correction territory because it is down more than 10% from a recent peak. NASDAQ is into correction territory a bit deeper, minus close to 15% year to date. But what's interesting is that Canada, EFI, so Europe, and the emerging markets are down by much less because they were cheaper. So again, when the US stock market corrects, the tide tends to bring everyone down with it, but you have more protection when you're invested in markets that were cheaper. So that's the reason why we really like TSX, we like EFI, we like emerging markets. The valuation gap between this and the US in the long run, I think, favors the returns for, and this is outside of the US, and it also gives you some more downside protection in the short term. So that's why we tend to tilt or overweight in equities on these markets. Right now, we're defensive. We're neutral in equities with some hedges in place, so we're defensive, but we still think long-term global ex-US is the place to be. So what's happening? Well, the main thing is that rates are going higher. Rate hikes are coming in the US, where Federal Reserve, the US central bank, signals very strongly that March should be the date of the first rate hike, and we'll have a path of rate hikes in both the US and in Canada. So the Fed is more important for the markets. The Bank of Canada, of course, it's more important for your personal finances, but both central banks, about 4 hikes are expected on each side of the border in 2022. Probably 4 more in 2023. There's still a lot of uncertainty, but this is the base case scenario we're working with right now. And both governors, Mr. McClem here, Mr. Powell, was pretty clear, saying that, well, March, it's going to be the start. And then after that, more hikes are coming. So if you have a line of credit, the preferential rate will go up. It's a financial institution, so you'll be paying more for your line of credit. If you have a variable rate mortgage, the rate's going to be coming up. So 1% this year, probably 1% next year too. So prepare accordingly. If you need to renew your mortgage, the next decision date for the Bank of Canada is March 2nd, 2022. So that leaves you about 6 weeks. So let's dig into financial markets now. So very tough start for the year on Wall Street at the close last Friday. Just found this chart. I thought it was very interesting, so that's why I brought it. It's 1 week old, but still, that was the worst 16-day start to a year in the history, or at least going back to the 1930s. So if you think it's pretty tough out there for the stock market, well, you're right. Never seen such a tough start. So what's going on is that, well, we had a lot of optimism from retail investors. If you look at the AAII survey here, the numbers that are the share that is bullish, so positive, minus the one that is bearish, so pessimistic, it moves through time. As you can see in 2020, 2021, lots of optimism, but now this optimism has faded. So bringing the stock market down, and the stock market going down leads to more pessimism, and you kind of go into that spiral. So now we see that the balance of sentiment is the worst since 2013. So is it time to go bargain hunting? Probably yes. Of course, you need to talk to your financial advisor to make sure that your risk tolerance is always respected in what you do. So the best investment you can do is the one on which you won't lose any sleep. So if you want to start putting money at work, doesn't mean that next month the markets will be higher. Next week the market's going to be higher. But when you have the correction territory, usually in 1 year and 2 years, you'll be looking back and say, well, generally this period was a good time to put some more money at work, or at least it's the worst time to get out of the market and sell what you have. So patience is always the thing. And if we talk about bargain hunting, so where and what, well, that's where valuations are at play. Because if you look at what went well over the last few years and what didn't. So on the left, you have technology, something that went very well. And on the right, you have energy, which didn't quite outperform. So the charts here, they're both the same concepts. On the left, you have information technology. On the right, you have energy. And on both sides, I just divided the price of the sector by the price of the S&P 500. So if the line goes up, that means that the sector is outperforming the index. And if it goes down, that means that the sector is underperforming the index. So on the left, as you can see in 2019, 2020, technology was a strong outperformer in the US. Some consolidation in 2021, another period of outperformance in late 2021, and now it's giving back some of this outperformance. On the right, at the same time that we had technology outperforming, we had energy underperforming. So it was underperforming the index, and now it's starting to outperform very strongly. So the last few years of trading have brought technology to the forefront as being one of the most expensive sectors. So it's not because something's expensive that it can be even more expensive. So that's what we saw over the last few years. But now it seems that we're deflating from that and we're rotating towards what is valuable, what is cheap. So energy, financials are now in favor. So rotation, so selling the winners in technology, using this volatility to rebalance portfolios and go more towards value, more towards energy, more towards financials, more towards Canada, emerging markets, Europe. This is a good opportunity to do that. So if you have some dry powder, you can add some more. Again, if it fits with your risk profile, so speak with your financial advisor, but at least rotating and not just selling and getting out of the market. That's a good opportunity here. And even, I mean, this is not looks like an annual chart, but it is just year to date as of the close on Wednesday, so January 26th. So on the left, you have the S&P 500. The index was down 9%. On the right, the TSX, the index was down 3%. So if you're in the right regions, you had different levels of pain. Okay, so TSX is cheaper, came down much less than in the US. And if you were in technology, well, you had some issues. And if you were in energy, well, actually you're up on the year. So rotation, going where there's some value, getting out of things that are being sold, getting into things that are cheaper and that have more momentum. That's a good opportunity to do that. So if just looking maybe at a more macro level before we end here, this is this is for the US, so Wall Street. You have S&P 500 on the left, you have NASDAQ on the right. So the recent volatility brought the valuation, so those are the forward price earning for both indices, back more in line to the values we had pre-COVID. So on the S&P 500 on February 2020, we had a multiple of 19. Now, because of this volatility, we went from 21 and a half, 22 to 19.5. So we removed a lot of fraud. So now we're in line with pre-COVID. So there's some value maybe that's being well, there's some fraud that's been taken on the S&P 500 and it's cheaper than it was before. So if you like the US stock market, maybe you have an argument there to buy it. NASDAQ, well, it used to trade during COVID at very elevated multiples. Now we're getting closer to where we were pre-COVID. So NASDAQ is cheaper. So if you're selling at a very cheap valuation compared to what you had prior to 2020, 2021. So getting out of the market now might not be the best idea. And Canadian and EM equities, well, more affordable now than in early 2020. So the TSX on the left, you can see we're trading now at the cheapest that we have seen during the pandemic, and it's even cheaper than it was in early 2020. So if you like the TSX then, you should like the TSX even more right now. This is our case. And on the right, emerging markets, same thing, trading close to the cheapest we've seen during the pandemic. And we think that it's a good value to be had by putting money at work in emerging markets. So what to watch next week? We'll look at employment reports. In Canada in December, we had a very strong report, 78,000 jobs were added. In the US, it was slower than that, so it was a bit of a letdown. And January in the US, the consensus is for 178, which is still good, but I mean lower than what we've seen, of course, through 2021. So let's see if the pace of the US labor market keeps on decelerating or picks up. But of course, Omicron is all, so we'll see what kind of reports we get. So that wraps it up for the week. ia.ca/economy. You can always look at the Economy and Finance 101 section if you haven't done so already. You can follow me on Twitter, on LinkedIn, and I'll again put the PDF version of this presentation on LinkedIn right after I'm done recording. So when you see this video, you can go on LinkedIn, it's going to be available. So thanks everyone, and I'll be back again next week.